with Peter Warnes, Morningstar's Head of Equity Research, and we're talking today ahead of the Forecast 2019-2020 report. Thanks for your time today, Peter.
Pleasure, Glenn. Always a pleasure to be here.
Looking into this, the report that's coming out later next week, what are some of the key standouts for you in say, looking ahead into 2019, 2020?
Well, Glenn, strangely enough, it's a little bit of the writings of the French writer Jean-Baptiste Alphonse Karr. The more things change, the more they stay the same. Because this time last year, we were saying that the Australian focus would be on household consumption and the RBA and what the policy track it was going on. And for the US, it was the three T's. It was tariffs, trade and Trump. And I suppose we could have thrown in the fourth T, being tantrums. So when you go forward to the present day, nothing has changed. But we have had some very, very roller coaster type rides in the equity and bond markets since July last year. And if you look back, see how it unravelled. We had a run to a record in September last year. Then we had a very, very sharp pullback in the December quarter, bottoming on Christmas Eve. And markets did go or touch bear market territory, in other words, down more than 20% from that high. And then since the Fed has done an about face, we have had a very, very strong rally and recovery through the first half of this year. And basically, really, the last couple of months have really been on the tear. Can the second half replicate the second half of last year? In other words, can we get a sharp pullback in the market in the second half? And I suspect the answers may be. And I think the more I think about it, from a scenario analysis point of view, I would suggest there's a greater possibility of that happening than not.
When we're talking ahead of filming here, you're alluding to some of the cover photo options for this report, and you're talking about this image of the climbers on Everest and alluding to the dangers of high altitude, and you said that the investors are at risk just as climbers would be in that situation. Can you just talk us through what you're referring to there?
Well, I think it's a good analogy to take because when markets are, when you're in high altitude, you need support, and those climbers that are clamouring to get to the top of Everest, they're all lining up and they need support. And they've got oxygen, and they're in danger territory, so they need support to get to their goal. Similarly, as the Reserve Bank or central banks have pushed investors further and further up and out the risk curve, they also are looking for support. And their support is the financial oxygen called lower interest rates. Look, never in my 50 years experience in the markets have I observed central banks easing and aggressively easing when bond and equity markets are at peaks. And I think that investors are in high altitude and in dangerous territory. And the descent is as dangerous as the ascent. And so I think there is enough evidence out there to suggest that things could get a little interesting. And of course, we have had, Osaka, and we've got another truce. Well, 7 months ago, we had a truce in Buenos Aires, and they got a bit argy-bargy after that. But there's no, trust is at a premium. The egos of the two people involved are, they're not surrender. There's no surrender here. And so the truce is not the end of the war. They'll have to get back to the negotiating table. I think this is kind of this is going to erupt again, and I don't know what the central banks are going to achieve, by driving the price of money down to ridiculous levels that hasn't worked for the last 2 years or 3 years, where you've got liquidity all over the place. Just pushing the price of money down will not get the velocity of money and the circulation of money through the economy going. The central banks haven't found the answer to that. And it's not going to do anything for productivity, because there'll be no competition for scarce resources because the price goes down because there's too much of a commodity out there.
It all comes back, I guess, to household wealth. And that's something that you've spoken about at length for probably 12 months now, that it's at such low levels. And do you see any signs of that changing?
Well, Glenn, look, the domestic economy is one that's, and like all developed economies, household consumption is 2/3 roughly of GDP growth. We have still got credit growth falling. The last figures out only last Friday from the Reserve Bank have got total credit still falling, housing credit still falling, and they're the two big. The housing credit is the big mover within total credit. Business credit has been reasonably positive, but it's nowhere near the housing credit. So you can't get the economic activity moving in a northerly direction unless you have more robust credit growth. So you've got to turn the credit growth around and get it going north. And until that happens, we are going to struggle in terms of GDP. We will have positive contributions coming from our net exports, obviously, because of iron ore and coke and coal prices are still on the ascendancy and a firm, thanks to China stimulus. And public demand through infrastructure spend and government spending will be supportive. But elsewhere, that there'll be, it'll be hard going. I mean, there'll be no positive contribution from dwelling investment, and as I said, household consumption will be under pressure. So we are very fortunate that that net exports are where they are. Otherwise, I think that we would have seen the negative growth in this third or fourth quarter of 2019.
Thanks very much for your time today, Peter.
Pleasure, Glenn, and we'll talk again shortly.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.